Mode.
Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending September 1st, 2017. Well, going into this trading week, um, most markets and most analysts had anticipated August would be a down month, but we finished up rather strong, and August ended up finishing in the green, even with the devastation that um, Hurricane Harvey brought to eastern, southeastern Texas, northeastern Texas. Um, so the markets are, still fairly resilient. Even with, we saw non-farm payrolls come in at only about 156,000. The unemployment rate ticked up to 4.4% from 4.3. Um, but really, the underlying data is what you got to really start looking at here. If you look at this underlying data, which is more closely watched by a lot of the analysts, is that wage growth only accounted for about 10 basis points or 0.1%. And that was short of the expected wage growth gain that they were looking for at 20 basis points. Year over year, our average hourly earnings remained stuck at a growth rate of about 2.5%, which is barely just ahead of inflation, which is stuck around 1.4, 1.5%. So, folks, this is opposite of what the textbooks have been saying for decades now about inflation versus unemployment. And the textbooks basically say that when unemployment is at full employment, quote unquote, full employment, which is around 4.5%, then the competition for more labor is going to drive up wage growth. And that's exactly the opposite of what we've got here. And I will remind everybody that we put so much money into the system by central banks, the what I call the puppet holders, um, of all of these global markets from China, Japan, the US, all across the ECB, Great Britain. All of this money sloshing around in the markets is going to have unintended consequences, not only in moving asset prices higher, because the PE ratio right now, the forward guidance of PE is about 17.7, and that'd be times the 12-month forward guidance. And that's near the highest we've been since the dot-com bubble. Okay. Um, the other thing that we've seen is a big rise in passive index funds, which basically are funds that say their mantra is rather than finding the needle in the haystack, meaning let's just pick out well-deserving stocks and invest in them. Let's just invest in the haystack itself, i.e., the market. So you're seeing a lot of companies or a lot of passive index funds have moved up dramatically. And also since the dot com bubble bust, we've seen ETFs really take off. And what we're seeing right now is about up to 22, 23% of all equities are run through ETFs. Now, why does that matter to us as day traders or common retail investors? What means is that when we do have a market sell-off, rather than a typical investor basically going, well, I'm going to sell stock A and B, but I'm keeping stock C and D because those two are better stocks, but the other ones are a little bit higher beta, so I'm going to sell those. Um, Now, what they'll do is they'll just sell the ETF. And when they sell the ETF, that ETF may be an index across many different stocks. So that ETF, in order to rebalance its funds, is going to sell all those stocks. Passive indexing is even worse, where they own a percentage of every stock that's associated with that index. In this case, the Dow or the S&P, which is even worse. So when the markets start going down, these passive index funds start selling, but it's very indiscriminate. It's across every stock. That's going to tend to accelerate the um, the depreciation of equities once we start to get into this downward drift. Okay, so these are just some things that we've got to really pay attention to. But like I said earlier, the textbook definition or theory of low employment will drive wage growth lower is not happening. And some analysts are trying to account the blame to the Amazon effect, but I think if you look at it, it's not just Amazon; it's all of technology. because we've got Uber, driving down taxis in that piece. We've got Airbnb and others driving down the cost of staying in cities or countries around the world. We've got AI, artificial intelligence, driving down and has the potential to drive further down wage growth. We've got robotics coming in the manufacturing side, and robotics are starting to come into non-traditional areas where you see robotics, in the food industry and others. We're seeing hydraulic fracking, which has driven down dramatically the cost of being able to extract energy from the ground, which is driving a wedge into OPEC. And there are many other areas here where technology is just totally rewriting the books as far as cost of wage growth. So, in fact, a lot of uh, employees now are probably fearful of asking for a wage hike, which is keeping wage growth subdued. So the central banks are in a conundrum here. And we're going to see an unwind of what I call the BS strategy. That's the balance sheet strategy of Janet Yellen. Now, next week is a holiday. This is a long holiday weekend, and we got a short holiday week next week. But we've got the Fed coming, or Super Mario Draghi coming out next week. They're going to talk about the ECB monetary policy, and most people believe he's still going to try and talk the euro down. I've been saying now for the past couple of weeks that a counter trend move in the dollar to the upside makes sense against a downward action in the euro, just because Draghi doesn't need a euro over $1.20 to the dollar. So I think that's going to happen. So we've got a number of these things that are really coming together. And then the week after, September 20th, a couple of weeks after, we get the Janet Yellen. We finally call her Aunt B. She steps up to the press. She does her quarterly press conference, and we're going to see where they are with interest rates. Keep in mind the U.S. markets right now, the 30-day Fed Fund futures is pricing in about a middle 30, higher 30% chance of a rate hike, not just this September, but by the end of the year. We're seeing that in evidence by stronger bond prices, lower interest rates. So all of these things go against the textbook theory of what should be happening. This is causing the central banks a lot of conundrum. Why is that important to us? Well, like I said before, with these passive index funds and ETFs, when the market starts going down, what's in the central bank's playbook to help relieve some of the pressure? Well, we're already at super low interest rates, but folks, get used to negative rates. They were introduced in Europe, and we may even have them here in the US if the markets have a large enough pullback where the Feds really need to start finding some additional ammunition here to do this. Now, I'm not saying the markets are going to crash. I do say we have not had a 3% pullback the entire year. We're coming up on a record here. We've had minor pullbacks of 1 or 2%, but we haven't had this 3% pullback. And I'm looking for the mythical 3% pullback, probably even up to 5 or 6%. Possibly before the end of the year. And then I think we'll make another run higher before we roll over in 2018, where I think the whole market is going to shift gears. Right now, you're seeing a nice little move up in the last 4 days of the year. You can see here, we were in this downsloping channel right here. And then we had a breakout right there. And then it just took off, and it took out our R1, which was our first level of resistance here. And we challenged this, or the prior peak right here. You can see we moved up above it, but we closed slightly below it. So we may run into some strong resistance just trying to get over this second level right here, which really now becomes our R1 level, right? And then, of course, we got our all-time highs here. If we do not take out our all-time highs on a weekly chart, that means we failed to make a higher high, which means on a longer-term basis, the odds favor coming back and resuming a little bit of a downward trek here in the month of September. And I will point out to you, going back 100 years, and looking at stats over 100 years, September has seen the Dow average a loss of about 1.1%. All right, now that's the Dow. Other stocks have been, September is traditionally a weak month as everybody comes back after this long Labor Day weekend here for U.S. markets. Now keep in mind, Globex will open, the futures will open Sunday night. It'll be an abbreviated session. They close again on Monday. They don't open again till Monday night. but we're going to have a day off for equities on Monday, and then the markets really resume back again. So you can see this breakout as I'm showing you here on the screen, and then we moved up, and you can see the buying versus selling volume over here, and we're sitting right at that level right there. Okay. And then you see we've got a lot of support down in this area here where we got buyers versus sellers here over volume. Buyers won out here. Right here, it's a question mark as to who's going to win out, buying or selling. If we do not take out this level right here, roughly where we closed, around 24.75 area, and hold it, then the odds favors coming back down into this area down here. So net net, we're probably going to be in this range as we go into the week. Now, it's going to be a week with a lot of potential data coming out and hitting the tape. Okay, we got a lot of Fed governors talking. Monday's a holiday, so nothing's happening there. And then Tuesday, we get Fed Governor Brainerd speaking. We got the Minneapolis Fed President Neil Kashkari speaking. We got the Dallas Fed President speaking on Wednesday as well, Robert Kaplan. Wednesday, we come into ISM manufacturing, and then we get a couple of different smaller finance ministers talking, but not a lot. And then Thursday's the big day next week for the ECB. They announced their uh, uh, they announced their central bank ECB central bank monetary policy statement. So that's coming out. So this is going to be really interesting. And then we get the Fed president Thursday, also William Dudley speaking. Cleveland Fed President Loretta Mester speaking, and then Friday we wrap it up with the Philadelphia Fed President Harker speaking, and then we got so notice what I said this week. Almost every day when we come back, Tuesday, Wednesday, Thursday, Friday, we got a lot of Fed governors speaking. Why? Well, A, they haven't met a microphone they didn't like. B, every time they talk, they can introduce volatility in the markets, whether they're for or against interest rate hikes or for or against balance sheet reduction. All right. But C, 10 days before September 20th, which makes it September the 10th, they're now have to go lock lip. They have a blackout period where they cannot do press conferences. So this week, essentially going can get out there and talk about what their thinking is around Fed policy. So next week, as we kick off, let's see here. Sorry, I had a little bit of a bump in my my mic here, but I got it all fixed now. But we got all these Fed governors speaking this week because they've got a blackout period starting September the 10th, because they've got 10 days that they can't say anything. Actually, it starts on September the 9th. So that's why they're speaking all this week, and that can introduce volatility to the market, let alone where I said over the past 100 years, the month of September has seen an average pullback. So September is not a kind month. So you put all of this stuff together, and that's why I think we're going to have a hard time moving up here. If we do, watch a bear trap or a bull trap where it just comes in and it rolls right back over again. Okay, so that's kind of what I'm setting up for this week. In fact, I would probably be more prone to be long volatility this week than short volatility. And if you've got strategies on that are short vol, then you need to hedge those. All right. And for our members, we talk about various ways to hedge the market. So this is one of the things that we're looking at coming into this week. Okay. Now, the other thing that we're watching very closely is the Russell. The Russell had a nice little move on as we went through the end of this week. You can see this breakout of this down. I don't have the channel drawn on here, but you can see we challenged the 200 EMA. It actually regained the 50 EMA here. If we roll back over in the Russell is kind of like our canary in the coal mine. We actually were in the red for a few days this year, going back over a couple of weeks ago, and we regained it. You can see the 2017 open price here, and now we're well back up. But the Russell has been in a very tight range all year long. And the other one that is prone to more downward action or aggressive downward action is the only market that actually went down this Friday was NASDAQ. And you can see here with NASDAQ, we actually, and I'm going to just adjust this here and show you guys, we actually made, well, let's get this shot here like this. We actually made new highs in NASDAQ this week. We made, NASDAQ came up on Friday, made new highs, and then closed off the new highs at 60.19.75. It's setting itself up for a bearish divergence here. It's what we call a poor man's bearish divergence, but that does suggest we'll probably come back to this huge mass of buyers underneath NASDAQ sitting here. So we're looking at about a 100-point drawdown sometime next week. That would be what I would expect in NASDAQ. So there'll be opportunities here for those that are looking at Qs, maybe going to the downside. If we look at some of our other trades here in the market and just kind of where we're sitting, if we look at treasuries here, you can see here in the bond market, well, we had this huge move lower in the bond market on Friday, over a full handle. We just got overextended here, but I think we're going to see another attempt at a rally here. If this second rally fails, that would be the time to go short bond market. Okay, so we're going to watch this fairly closely. And then, of course, if we look at the currencies, well, what can we say about the currencies? The euro, or the dollar rather, is in that balance, right? If we look at the dollar, you can see this downsloping trend line. It's given us a little bit of a bullish divergence here. I do believe we'll bounce back up a little bit. I think Draghi is going to be more dovish than people think, more cautious. It'll have a tendency to push the euro lower, dollar a little bit higher, but it's not going to get too far. I've been bearish the dollar for most of this year, mostly bullish the euro. The euro came down and hit our level. I had called the level of 102. It came down and hit 104. And if we look at the euro now and where it's sitting here, let me just get this on the screen. Let's just move this down a little bit. Let's see here. So if we look at the euro currency here, you can see that we moved up, and we've off of these highs here, we hit the mythical 120 area, almost 121, but about a little over 120. And then we're pulling back. This is just, and we can see the bearish divergence here. So this is just a normal pullback, a little bit of a consolidation. I think the euro will come back down to the 117, 116 area after the ECB meets. That's what the charts are saying right now. Okay. And that would be the way I would look at it. Meanwhile, if we look at the gold market, gold has just been on a tear recently because the dollar has been so cheap. You can see gold actually made a new 2017 high on Friday, right? And so if I highlight this, and let's just move it up, see if I can grab this thing here. I'm having a hard time grabbing it. But you can see gold made a new high of 1334.5 right here. There is no divergences here, which would suggest just a lot of volume. And in fact, if we look at the volume, look at down below, starting around the beginning of August, where I've got on my volume, folks, I put a 5 EMA and a 20 EMA. And anytime the 5 is over the 20, that means more volume is coming into the market, whether it's bullish or bearish. In this case, it's bullish, and it seems to indicate that this is a valid move here. And you can see over as we get over here on Thursday and Friday, all this volume that was coming into the gold market. Now, what can put a stop to gold moving higher? I'll tell you one thing. If Yellen is a little bit more hawkish and they come out with still on track for raising the rates before the end of the year, you'll see gold sell off a pretty good bit, at least 15 to 20 points, possibly even more. But if she comes out dovish, which is what the markets are forecasting, which is why gold is going higher with low inflation, dollar, going down the toilet right now, this is all bullish for gold. So, and you can see here in this long consolidation pattern right here that lasted almost 2 weeks, I had said the odds favor a breakout to the upside. Not only did we have the breakout, but it was supported on stronger volume as well. So gold right now is in a bull cycle. I would not want to chase gold at this level going into these central bank meetings. It's a little bit too risky. I think if gold pulls back to the 1300 area, maybe a little bit lower than that, that could be an interesting play to the upside if we see gold start to take off again. Okay. You can see silver is probably the same way. Silver has been moving up. We're breaking out of this downsloping channel. You can see volume over silver here. The 5 is over the 20. And if we just back it out and we look at the chart here of this downsloping trend line, let me just get this on the screen here. Let's put it on a weekly chart. That'll probably help back it out just a little bit more. If we go out on a weekly chart, you can see this downsloping trend line. We're finally breaking out here. And then again, if we show volume over a longer term basis, look at this. Volume since April of this year has been higher than normal on this down move. And now we started this up move here in the beginning of July, and volume has basically held up. And just over the past 4 weeks, all of the month of August, you can see these last 4 bars here, strong volume pushing silver above this downsloping channel. So all of these things are bullish, not only for gold, but for silver. Palladium is up big time this year, but you can see these huge moves that we're getting across all these precious metals. All right. So these are just all, they speak bullish for all of these metals here. And the other thing is, let's look at industrial metals. They've been outperforming everything from iron ore to zinc to copper to steel. Look at this. This is I would not chase this, folks. This is DBB. It is the base metals fund. It goes up with industrial metals. By the way, industrial metals have outperformed precious metals this year. That would be gold and silver and palladium. But industrial metals have just gone through the roof. And you can see this huge move here in DBB. This suggests that I wouldn't chase it. We could probably have a little bit of a settling in price. And this is doing this because China is showing a lot of strength this year in their economy. If we look at copper, this is the copper commodity complex, and you can see here copper looks just like that DBB chart. I mean, it's just been on a tear since right in this area here. And if we look at volume, you can see over the past week, copper is just taken off. A lot of volume in this commodity complex. That's a lot of speculative buy-in right here. I would not be long copper right now. And for those of you that are, whether you're in JJC, Juliet Charlie, or Freeport McMoran, FCX, I would probably back off just a little bit. So like, for instance, if we look at Freeport McMoran, we look at the MACD here, and we just kind of come out and look at this, you can see it's a little bit weaker than what copper is showing. And if we look at JJC, which is the index that tracks copper, it looks just like it, right? I wouldn't chase this up here at this point. In fact, probably selling calls, doing a bear put spread or a bear call spread as a credit spread. These things make sense to me in these markets just to see a little bit of a settling in. And finally, if we get to oil, we're on 15 trades in a row now of successfully trading oil with our strategies. You can see on this weekly chart here, and I just wind it up, and let me just move the chart up a little bit so you can see a little bit better. You can see here on this weekly chart how, look at these bars here. Every week, oil has been moving lower, 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 lower. Now, a lot of retail traders were thinking they were going to go long the markets with Hurricane Harvey. Now, for our members, I was telling them to do just the opposite. And that's what happened. And if you understand the oil value chain or the supply chain of how oil moves from the ground to transport to refinery to transport to the pump or wherever oil is going, you would understand that oil would more than likely go down with Hurricane Harvey. But refineries actually moved up a little bit in a Machiavellian sort of sense. Now this opens up the opportunity for crack spread and other near-term trades that, you know, for our members we'll be taking a look at. But you can see on this chart here, this movement in oil. Now this recent weekly candle would suggest oil is going to bounce higher. If I look at this right here, you can see this last candle here. And it's really almost like a hammer, which would suggest oil moved all the way down to about 45.40 and closed up at the upper part of the candle, which would suggest we're going to challenge this downsloping line again. And you can see we have not broken this downsloping line going all the way back to the middle parts of July. And then for the month of August, going into July, we've had 5 weeks in a row of red weekly candles in oil. I think that's probably going to start to break, and we'll see a little bit more of a bullish action in oil. And then if we challenge this downsloping line, I think we can move a little bit higher. If I put it back on the daily chart again, you can see this downsloping channel here. There are no divergences, bullish divergences near term here. So that would suggest that if we do move up a little bit higher, it's just going to stay in this range. So for our members, we're still on track with, we were in our October futures trade, then we got into the DEES trade. So we're just going to keep rolling these things and continuing to take profits as long as the markets give it to us. All right, everybody, a long holiday weekend for folks in the U.S. For those of our members that are in the Asia Pacific area or Latin American markets, Canadian or European markets, you'll be open, or at least some of you will be. I know Brazil has a holiday later this week, an Independence Day, but otherwise the markets will be very quiet on Monday, and then we pick everything up back to holiday season, back to school season, or back from holiday season, school season, and then we'll start to see volume come in the market, and we'll see if this September goes along with the 100-year century mark of September being a little bit more volatile and a slightly down move. So that's where we're sitting, folks. Enjoy the holiday weekend. For our members, Sunday night we have off. I'll pick it back up Tuesday morning with our pre-market session. If you're not in our group, I highly encourage you to come in. We got a lot of really interesting things getting ready to hit, and you should be a part of it to know how you want to play these things. Have a great weekend, everybody. I'll catch you guys up Tuesday morning with our pre-market. Ciao, folks.